For today's main topic, I got to give a little disclaimer. The disclaimer is copied down in the description in its fullness, but what I'm about to do is not investment advice. The example I'm going to show you is for educational purposes only, and the assumptions are only perfectly valid within the tool that I have, the spreadsheet that I made. And the spreadsheet that I made, admittedly, is using tax law from 2021, 2022. So it's a little out of date, but the example we're going to run through is still important for your financial education. If you can see the video, there's a mildly intimidating looking spreadsheet that's in front of us. I'm going to talk through the situation that is reflected by the current inputs, and then we're going to talk about the graphs that populate down below and discuss some of the actions that can be taken in order to help mitigate the risks that required minimum distributions can expose us to. So what we have right now is a 30-year-old couple, husband and wife are both 30 years old, and together their income, their MAGI before taxes, is $80,000. That's a reasonable income. And there's some calculated stuff about their taxes that's really not important for understanding the example, but just know that the spreadsheet corrects for tax brackets and factors there that get complicated, too complicated to explain in the scope of today's main topic. Let's go into the particulars for their retirement. At age 30, they have $40,000 saved up in traditional investments. They started by investing in traditional sorts of retirement accounts. Later were introduced to Roth and decided they wanted to try pushing into Roth, or their employer went from offering traditional only employee-sponsored retirement accounts to having a Roth option. That's quite valuable. So they switched over to putting the money in their retirement-sponsored account to Roth. The employer contributions are still going to traditional, and they match 100% of what you put in. So right now they're putting in $5,000 that goes directly into their Roth portion of their 401ks or their employee accounts. And there's a match of $5,000 that goes in there, but it's traditionally invested. So each year, Roth and traditional get $5,000 in contributions. We're going to assume that doesn't change for this example. We're going to do everything in today's money. Let's assume that this couple wants to retire at age 60, right after they can access their retirement monies. For the purposes of this spreadsheet, it's conservative to estimate a higher growth because we're looking at how required minimum distributions can exceed a safe withdrawal rate. So you want to be a little aggressive. So I popped in 11% for how much growth we expect their investment portfolio to do. I popped in 3% for assumed inflation. You actually want to be on the lower end. So if you assume 3 to 4%, popping in 3 in the spreadsheet is going to be more conservative. Net growth for their investments is going to be 8%, then 11 minus 3 equals 8. Now I'm going to move to the upper right table. The upper right table shows some information about their retirement strategy. They want to, again, retire at age 60. That's when they are going to no longer have any earned income. Their nest egg, using the numbers we've assumed, if they continue contributing at the assumed growth rate, again assumed, in today's money they'll have $1.7 million. Woohoo, that's great. They plan on implementing a safe withdrawal rate of 4%. They follow the 1998 Trinity study, and they want to stick with it. It's going to just be flat. That'll give them an annual income in today's money in retirement of just under $70,000. If you talk with almost any financial advisor, they're going to tell you once you hit retirement, you want to favor your traditional account first and start paring that down before digging into Roth. Now, that's not a blanket statement. It's not financial advice. It's just something that, is something you hear a lot. So this couple is going to start, in this example, by taking money out of their traditionally invested funds and then taking out a Roth after the traditional is worn down. They, in this case, would like to leave as much of the Roth money to their kids as possible. And they know that that money that they leave to the kids, if it's in Roth, can grow tax-free for another 10 years. The rest of the spreadsheet talks about what they can do today to convert traditional money into Roth money. The last bit, results by life expectancy, we say they expect to live until age 95. And there's a little toggle that either says yes or no. Do required minimum distributions exceed your intended safe withdrawal rate? And in this answer, it says yes right now. Warning. Well, this couple wants to take 4% out because that is what they believe is going to leave them at acceptable levels of risk for not running out of money in retirement. However, the IRS on the traditional money, their traditionally invested retirement nest egg, they're going to impose required minimum distributions, or RMDs. We can see when we look at the first graph here that required minimum distributions really start to heavily impact how much they're taking out of retirement right around age 84. Now, that's not necessarily when RMDs kick in, but that's when RMDs are going to start exceeding their safe withdrawal rate of 4%. We can see that up to that point, the amount of taxes that they're paying from their distributions from traditional accounts is static, and then it climbs. The next graph down here, the one that is Broncos orange and blue, represents the balance of the nest egg. It always equals 100%. Orange is going to be traditional, blue is Roth. What we see is right now, they're primarily invested in traditional at age 30. And the Roth account is the minority of their nest egg. And as they invest and things grow, it evens out around a 40-60 split. Right at 60, when they start taking money out, you'll see that the amount of traditional shrinks and Roth takes over up to a point that's well beyond life expectancy. This last graph that I show, if you have the video, is the most important, in my opinion, to consider while looking at this problem. The yellow line represents the retirement income from traditional investments. Now, the blue also equals the same thing, but it's the amount that is applied from required minimum distributions. So right around age 69, it looks like, is the last year where RMDs didn't mean anything. Right around age 70, they kick in. And the RMD requires more than 50% of what they need to take out. And it ever increases until right around that point of 83, where required minimum distributions equals or exceeds their safe withdrawal rate. The blue line comes up and above this orange line. The orange line represents the intended distribution that they want to take out from their nest egg total. So if that blue line bumps above, that's when we get the little warning. Yes, your required minimum distributions are putting your safe withdrawal rate strategy at risk. You're not going to be able to follow it practically in retirement. Eventually, it does come back down, but we don't need to talk about that because it happens after 100 years old, and we said we are running this example for 95. So what can we do to fix this? Well, first, what we could do is consider moving a lump sum, rolling over a lump sum of the traditional money into the Roth money right now. Now, if everything is invested in an employer account, an employer-sponsored retirement account, they're going to need to talk to the manager of their 401k, 403b, whatever it may be, and ask if this is something that's possible. For some people, it's not. And just because it isn't a possibility now, if you ask, it doesn't mean it can't become a possibility later. That's something that happened to me in my past. But let's say that they can. Let's say they're able to move $6,000 of their traditionally invested money now. Again, they have $40,000 today at age 30, and they move that over to Roth. Well, that increases their tax burden for this year by $1,200, a little more than that. But by doing so, just that one lump sum keeps the blue line below their intended withdrawal rate. So by just moving that little bit of money, they're able to be safe. And that was the big thing we were concerned about. So an additional $1,200 in taxes today solves their problem the way things are mapped out, assuming everything else stays static. That's kind of cool. I think that's a very easy solution if you wanted to do something today and then not worry about it and check in on it later. And they could do a little bit more if they wanted to be a little more safe, but there's also something else that's really cool. On this cell right here, 46F, if you can see the video, the total amount of taxes under the original assumptions, the total amount of taxes they'd pay in retirement equaled $237,000. If they made that conversion today and spent an extra $1,200 today in taxes, it drops their total tax exposure over their lifetime to $178,000. That is a substantial improvement, but I think we could do better. let's say that they're not able to do this one lump sum and they don't want a quick and easy fix and they want to kind of manage this a little bit more. They want to be a little bit more involved with this retirement strategy because they're worried about their overall tax exposure. They want to, on the whole, minimize how much money they give to the government over the span of their life. So they say, well, the money that my employer is investing, let's take it from the traditional and roll it over to the Roth every single year. Again, we're assuming that's something that they can do. If they do that every year for that $5,000, it gives them an extra $990 in taxes. Not quite $1,000, but that's every year until they retire. The amazing thing is how much that reduces their overall taxes. Remember, it was over $200,000 in tax exposure for the initial example. By rolling that money over from traditional to Roth every year, their overall tax exposure is now only $60,000. And that doesn't include rolling over what they have today. If they were to take all of the money that they have saved up in traditional and roll it all to Roth today and then do an annuity type rollover every year where you take the traditional contributions, move it over, you minimize your overall exposure to taxes to only $37,000. That's crazy. We took it from over $200,000 to under $40,000 in tax exposure on the spreadsheet. And there's one more thing we can do to get it lower, and that's going to be called the Roth conversion ladder. I don't have time to explain it today, so subscribe if you want to catch an episode where I do. But effectively, it's going to be rolling money over from traditional to Roth after you retire in a way that doesn't get taxed because you stay below the 0% tax bracket. So let's say instead of rolling everything over today, they do half of it. They take $20,000 of their $40,000 that's in traditional, move it to Roth. Then, in retirement, they prioritize taking money out of their Roth account instead of the traditional account. They do the opposite of the standard advice. But they also prioritize a Roth conversion ladder. Well, if they do that, well, they can get their tax exposure a little lower, closer to $30,000. And what we're essentially doing here is saying, let's have a little bit of money in the traditional today that grows and can be mitigated before RMDs really kick in. I don't know if $20,000 is the smallest they can do, so I'm going to try $15,000. $15,000 ended up in a little bit more taxes. $20,000 might actually be the sweet spot. I think I might have nailed it. $33,000 in overall tax exposure for their retirement strategy seems to be about as low as I can get it on the spreadsheet in short order. But this goes to show that by taking some intentional and educated approaches to our retirement plan, we can reduce our taxes, in this example, by over $200,000. That's crazy. Now, that's the kind of lesson that I wish could be taught in schools around the country. That's the kind of stuff that I wish that everyone who graduates from high school, everyone who graduates from college can understand right up. This isn't something that I've ever seen in a personal finance class. It's not anything that I've even seen on YouTube or in a podcast before. And it's something that I'm very honored to be able to share with you today. Next week, I'm going to be doing an interview with a registered financial expert who's going to help us understand insurance, most particularly life insurance. Not the most fun thing to talk about. It's not something that we all like to think about, but it's very important. If you want to learn about life insurance, the difference between term and whole, and other fun insurance topics, please subscribe and don't miss next week's episode. Until then, until next Tuesday, budget bravely and enjoy your hope-filled financial future.